All right, everyone, we're watching the market very carefully right now. It is up 80 points, so trading near session highs, actually, as investors start to focus heavily on rising Treasury yields. So they're basically shrugging that stuff off, which is good news. You get the 10-year Treasury hovering just below 3.1%. Can we show the yield on the 10-year? I know we've got it there in the news alert, but let's take a look right here, 3.08%. So this is a big deal. And the reason this is a big deal is because if Treasury yields start going up, and the expectation is that they will, well, then the cost of borrowing for our country and for everyone else here is going to go up. Not just the U.S. government, but of course mortgages, car loans, et cetera, et cetera. So what does that mean for people's ability to spend? Joining me right now is the Gartman Letter editor and publisher, Mr. Dennis Gartman. Dennis, good to see you. I mean, look, I kind of wondered for a while why we haven't had higher yields on 10 years. You know, you think about the health of the economy from a fundamental perspective. It's certainly improving. We've got a Fed that indicates it wants to keep moving. Shouldn't we be at 3.1%? Maybe even a little higher than that? Dare I say?
Oh, I think we should be a great good. I think we should be a great good deal higher than that, Trish. Let's first of all, those of us of a certain age can remember trading the 10-year back in the 1980s when we had an 8% coupon. The infamous 8s of 86 came, an 8% coupon that immediately went to a discount. That was an 8% yield. I can remember trading the long bond with a 14.25% yield. So the fact that we've gone through 3% of the 10-year is, to me, relatively inconsequential. Yeah. Can we get to 4% before the end of this year? I think that's reasonable. Can we get to 5% over the course of the next 2 years?
Is that dependent in part on jobs and earnings, et cetera?
Yes.
I mean, it's the overall fundamentals.
Yes.
So we should want that,
Yes, it's the overall fundamentals. Yeah, of course. The economy's doing very well. I made a speech last week in Austin, Texas, to the American Cotton Shippers Association, and the major topic was they can't find enough people to ship cotton. They can't find the trucks. They can't find the drivers. They can't find workers. And this is happening all over the United States. So the economy is doing very well. The Fed has no choice but to follow rates higher.
Okay.
And this is not going to be a consequential move.
But let me
Nobody should get panicky.
I hear you. Sorry, I got a question for you, because if the Fed is trying to move here, I guess I would just ask, where's the inflation, though, right? I mean, I know everybody worries and the Fed worries, oh, inflation can take off overnight, but I don't think it's a ton of inflation when you see the 10-year at 3.1%. I think that's, in fact, actually kind of normal. So, Dennis, we're not seeing it in wages. We're not seeing it really in the cost of products. So where's the inflation?
You will. Take a look at what's going on in the commodity markets, Trish. Since the start of the year, commodities generally, I keep two indices that I average out every day. They're up 9% from the start of this year. That's not inconsequential. That is indeed quite consequential. And here we are only through May. Take a look at what's going on in lumber prices, which have doubled over the course of the past 6 months. So you've got something going on in the commodity markets. Yes, there have been wages have been less aggressive on the upside than anybody might have been. No, I mean, actually, the dollar is actually getting strong here, demonstrably stronger against the euro. So under normal circumstances, over the normal circumstances, you would expect a strong dollar to give way to weaker commodity prices. Here we have a dollar that's up over the course of the past several months, and commodity prices themselves are up. So if there is an inflation, it's in the commodity markets, and nobody's paying much attention to that.
Very, very interesting stuff. Dennis, it's always good to talk to you. What is your sense of this market very quickly as we go through, you know, the whole, is it stay in May and go away, or do you think that there's some opportunity here this summer?
It's still a bull market, isn't it? Whether we like to, you know,
whether you like it or not.
Bearish arguments. Yeah, whether you like it or not, it's a bull market. It wants to go higher. I'd much rather own stocks in countries where the monetary authorities are being expansionary, where our monetary authority is being somewhat contractionary. But nonetheless, international shares on balance are all going higher. The movement is still from the lower left to the upper right. Don't fade it.